Yo, what's good, everybody? Welcome to the John Katz Show. I'm your host, John Katz, and we're here with a very special guest today, Jay Appel. Jay, thanks for coming on. Good, man. How's it going?
Good.
Jay is my brother-in-law and also financial advisor and Jersey boy.
That's right.
And avid golfer.
Just not just too avid.
Diehard Springsteen fan.
Yes, you're getting it all.
I want everybody to get to know Jay a little bit before we start talking. Not a stereotype at all, by the way. Jewish financial advisor from Jersey, Springsteen fan, golfer.
And Giants fan.
And Giant fan. How's the golf game?
And Yankees fan, so we'll just check all the boxes there.
There you go. What's the handicap these days?
It's down to an 11 now.
11.
Or up to an 11, I should say.
What was it at its best?
I think just about a 9.
9, okay.
Yeah.
How often are you getting out there?
At least once a week now.
You watching any golf?
You know, very little. It's not exciting when you can't hear the fans. You miss the Baba Booies. It makes it a little harder. But and it's the schedule is just not making it really fun.
Yeah.
But with all the events coming up now, I can't wait. No Ryder Cup, just with the Masters in November, and then the FedEx Cup coming up, things like that. Now is going to be the good time to play.
I haven't watched any, man. I don't know
why.
Haven't seen any? I haven't seen any golf. I haven't seen any live TV in months. I don't know what happened. I just use apps now. Like, if it's not on an app, I probably never saw it.
What's there to watch on live TV?
I guess just sports, right? That's it.
That's not even really
well, even
fun
that,
to watch.
Yeah. I just watch the highlights on like Twitter and stuff like that.
Right. There's not much to watch on live TV.
You got to see what Tiger's doing. That's about it. Has he done anything this year? Made any noise or no?
Nothing.
Is he healthy?
Yeah, of course he is.
I feel like everyone,
as he says, healthy.
Yeah. Everyone our age is always like going to always pull for Tiger, no matter what.
I always have and I always will.
I think anyone that was like a teenager in their 20s when he came on in 97, it's just he's always going to be their guy.
Yeah. I mean, you got to cheer for the old man now. I mean, I have to cheer for him. I just always liked watching him.
You think he's going to get the 18?
So much excitement to the game. How can you not watch him and Phil and just like enjoy it?
You think he's going to get the record, Jack's record? What does he need? 3 more now? No.
3 more in, I think so.
How many does he have?
Yeah, 15.
He's got 15 now, so 3 more.
I think it's 14 or 15. I think 15.
He would have killed that record when he was just streaking toward it. 2000, 2001. If he didn't have that whole period where it was just one injury after the other and the sex scandal.
It was the injuries, but it was also the swing changes.
Yes.
You look at all his swing changes and you look at the numbers, like it takes years
for sure
to perfect a swing once you make a change. And he was on such a tear and then decided, I'm going to change my swing. And he probably changed it because of injuries.
Right.
So he had to change it, and then it just affected him. And then he went from here to here, and it's like, then got it down, won some more, then changed it again. So once he finally gets a new swing, then everything else happened.
Well, it was right. Steve Williams, who had him at his perfect swing, right? And then he got rid of Steve the same time. All that sex stuff came out, and it's like he was never the same. It's like a perfect storm. It's a shame.
Yeah, everything hit him all at one time, but now he's, I'm glad. I'm happy he came back. I'm happy he won. I'm happy he turned it around. I think his attitude changed. He's just like, he's friendlier now to people. I think that's the key thing.
Way more humble.
I think it's really helped make him a little more humble and, beloved by people.
I think he'll get the record. That Masters last year, just the way he comes out for majors, I think he'll get another Masters or 2, get an Open or something.
I would hope so.
Be nice. He needs to go down as the undisputed best. I don't think Jack's even close. It was a different era, but
I still think Tiger's the best ever.
For sure. In his prime, nobody was.
That's a whole other episode that we can probably spend 2 hours on, just talking about who's more dominant.
Yeah.
But it's a different era. It's pretty funny. Not to switch the subject on it though, just in terms of era of sports. I don't know if you saw this. I saw a thing today talking about like, baseball records being broken.
Right.
And
Right.
Ricky Henderson's stolen base record. And the question was, will that ever be broken?
Right.
And people are looking at it like that's one record I think will probably never be broken because it's a different era.
Right.
Nobody steals bases like they used to, and that's one that'll probably, I think Bonds' record will go at some point. But
you think someone will beat Bonds' home run record? Yeah.
At some point.
They lax up on the juice. I don't know. That's a lot. Yeah, there's some records that you just feel like are never gonna.
Yeah.
You can't because, like you said, rule changes and things like that. You'll never reproduce the numbers guys were putting up when there was different rules.
Right. I think Ricky's record will never be broken, and then I think there's other ones out there that probably never be broken.
Yeah. I'd be surprised with the home runs. I don't watch any baseball, though. I shouldn't comment. I find it too boring. I haven't watched a full baseball game in like 20 years.
Well, it's long and boring.
Yeah. It's tough.
So it's tough to watch a full game.
They got a little action.
Yeah. It's a little too much.
Oh, man. Yeah, we'll do a whole segment with Jay where we have him back. We'll have a golf episode. We'll debate the greats and all that. Watch a lot more golf than baseball.
Definitely.
But no, seriously, thanks for coming on. We were doing this because I thought it'd be great to do like a financial show, especially now, with Corona and the way the markets have been and everybody's kind of worried and confused and they don't know what's going on or what to do necessarily. And like I said, Jay's my brother-in-law, so I don't only trust him with my money, I trust him with my sister. So that's a good endorsement. Before we get started, we're going to get into a lot of subjects. If people want to contact you with any questions, find you, anything like that, it's Jay Appel, Appel, but do you have an email or something you can give out?
Sure. My work email, jay.appel@nm.com.
You heard it. Email him, and any questions y'all have, any type of investments within the market, life insurance, kids' college, any kind of financial planning. If you need, like I say, he's a financial advisor. If you need to be advised on your finances, this is the man to talk to. He's in New Jersey, but he can help you out wherever you are, so hit him up. And I guess, it feels like the topic that's on everybody's mind is, like I said, financially speaking, what lies ahead. There's been so much tumult lately. All you hear is, the word depression, the economy, whatever. Most people that are feeling a little unsettled about their investments and stuff, what do you tell people right now, especially if they don't need their money right away? What's the main message people should be hearing?
Yeah, it's interesting you say that. I mean, it's in these tough times, it's hard to keep your perspective and focus on the big picture with everything going on. And my main advice to most people, especially the ones you're talking about, like that, maybe 20s or 30s or 40s, that have a good over a 20-year time horizon in retirement, is just maintain the course. It's the best advice I can give them, and I think that's something I was saying, right from the start. Maintain the course. Don't panic. Don't get emotional. Investing is very emotional, and people panic at the wrong times and try to take their money out when they don't, they say, oh my God, the market's dropping, I have to get out. And then it turns around and the people are sitting there holding their money saying, what do I do now? So, you don't want to panic in a time like this. Just maintain the course. If you're looking at people that are closer to retirement, you have to look at where you're currently sitting with what your investments are and what your current plans are, because, these things you can't really live through this and take your money out at the wrong times. So, you want to be able to make sure you're planned accordingly, that if you're close to retirement, that you're not sitting in the market in a very risky position, that if you're going to retire next year, you should not be sitting in 90% of your money in equities. So,
exactly.
That's my biggest advice for most of my clients and most prospects or anybody I really talk to, is maintain your course. And in the long run, the market always goes up and to the right.
Right. You always have said that to me, that if you look at the history of the U.S. financial markets, from the biggest depressions and crashes and everything else, it's never not then gone up again after that. Long term, it always gains, it always grows. Our
That's
economy is always growing.
In the long term, you're going to end up making, not a guarantee, but the long run, the market goes up. And I think I had shown you a couple of stats, I think through from the end of 09 or 08 or 09 to, from that last crash all the way through December of 19,
yes.
The S&P was about a 430% return. If you got in on that time or you stayed the course and you stayed in, your money came back. I mean,
right.
We're talking high level, so I don't have like all these numbers and charts in front of me to give you exact stats. But I mean, even just look at from March. I mean, we had talked about the crash. The market started coming down. The high was February, middle of February. We hit the S&P at a high.
Right, right.
And within a month, it dropped 35%.
Yes.
And then and everyone's like, "What do I do?" And that's what I'm talking about. It's like people that got out saying, "Oh my God, I got to get out." The day the market started dropping.
Right.
Got out.
And now it's back pretty much almost where it was before the drop, right?
It's up. From March to now, it's up about 45%.
Right.
And that's just the S&P. I mean, the Dow is pretty much flat, but then you look at the Nasdaq when we talk about all those crazy stocks that
even during some
conversations about the Nasdaq. I got it down. You're up 45% on the year.
Crazy.
It's insane.
The Nasdaq was doing well even during some of the panic, which is wild.
Yeah. Those names, the technology names, just
but long term, if you're relatively young, you're not retiring for 10 years. I mean, if you've got 401ks and IRAs and all that kind of stuff, stay put. If you're looking up your balances every day, it's like I'm always saying, when people get emotional, they make stupid decisions. If you're looking up your balances every day, you're gonna freak out and go, "Oh my God, I lost all this money. Let me get it." Right. Don't even look at it. Right, just. If you don't need it, don't even look at it, right?
Yeah, I mean, look, you got 20, you say you have 20 years, take a 40-year-old person who's got 25 years probably to 30 years till retirement.
Right.
You're going to see a few more drops in the market. I mean, this is the longest bull run we've ever seen. You got people that are 30 years old, have never seen this before. I've lived through, a few crashes already or a few corrections. We've seen so many and the crash is faster than the recovery.
Right.
It takes no time at all to go down, and the usual drop is about a 35% drop, but it takes a couple of years to recover. So we've seen it, we maintain it, but the thing is, it's like once you get out, it's like you're going to have to now go back in, but when do you go back in?
Right.
And nobody can time that. So the best, my advice is, that's why you get in, stay in. Take advantage of the lower prices. If you're putting into your 401k, put more into it if you could, or max it out if you can, if that's a possibility. But you're taking advantage of these lower prices. So when you're buying at one price now, the market drop, you're buying more at a lower price.
Right, right.
So your overall cost is going to change. So you're more like your dollar cost averaging it across the board. So you're always putting in at different prices. It's going to help you in the long run than just picking a certain time to get in and a certain time to get out. So you're going to buy at some highs, you're going to buy it, but take advantage when you can buy at the lows, because down the road it's going to pay off in your favor.
That makes sense. That makes perfect sense. So no, people, don't panic. You're looking at your retirement funds and you're going, man, what happened? And to be honest, it should be pretty close back. But look, it might not be the end. It's a roller coaster right now. You look at some of the people are looking at unemployment numbers and stuff. We could see another huge dip before the end of the year. And same thing. If you see another huge dip and the Dow goes from 28 to 25 again, people are going to freak out again. Don't freak out. Just stay the course, like he said.
Stay the course, and that's it. Stay the course and diversify.
Diversify. Yes. Keep it a little less risky. Don't put all your eggs in one basket.
Exactly.
What do you say that all the time. How about people first starting out? I mean, there's a lot of, I know you deal with personally a lot of young people, young families. Yeah. They may not have any money in the markets, and they're looking to first purchase financial products. They may be a little weary, looking at what's going on. What would you recommend if people kind of just want a safe investment, keep pace with inflation, that kind of thing?
So it's, the people that are just starting out, let's talk about maybe, 30s, early 30s, mid 30s, just starting a family, just getting going in their career, building up a little bit of a nest egg. Those are my favorite people. Those are the ones I love to work with the most. They're looking to put something in place. They want to buy their first home, about to have a kid. All these different things are happening in their life that it's great to work with them, because it's, to help them build a plan for their future.
They're looking for security.
Yeah, to build security in their future. And, the one thing I always say to people, I look now, and I think you and I have talked about this, and, I know Sarah and I have talked about this as well, is people now, when I have older clients or, people like my age or a little bit older than they always say, I wish I did this earlier. I wish I did that earlier. Only if I started earlier. So my first advice is it's never too early to start. It's never too early to start any kind of savings plan and type of investment plan or any type of like risk management planning. So I always look at it as like, define your goals, like know what you want to accomplish in the first few years, like in a 3 to 5 year horizon, especially if you're starting out a family. You got married. Okay. Yeah. You probably have an idea. Most likely you have an idea of when you want to have your kids or your first child, when you want to buy a home, when you want to move out of your 1-bedroom studio apartment or, that you're living with now, with the baby in the side, in the small little area. So, you want to make those changes, yes. You have those goals in mind. So, I always look at it as like map that out in some aspect. Budget, make sure you have a budget in place. Don't overdo it and don't overextend yourself.
Yes.
There's like the first few things. I mean, when it comes to working people, those are the first questions I always ask people, like, younger couples, what are your short-term goals? What are your midterm goals? Like, give me some ideas of what you want to accomplish professionally and personally so we can kind of work with you that way and kind of get an idea of what's important. But most importantly, is to have a plan in place. Like before you even start investing and saying, I want to buy this, I want to buy that, I want to have this much to retire. Before you can even start that, the first thing I always look at is like, most important is put a plan in place to protect yourself and your family against risk. Protect yourself with life insurance, disability. You kind of look at it as, at the end of the day, it doesn't matter how much you really save or invest. You're the machine that's kicking out the money.
Right.
And if you go down, everything else is going to fail too. So
everything else is extra.
Everything else is extra, so it's going to fail too. So you want to make sure that whatever is funding everything stays moving no matter what.
And like you said, budget. It's going to be different for everybody. Everyone's going to be making a different amount. Everyone's going to have different expenses. But first and foremost, like you said, protect yourself, protect your family. Worst case emergency, something unforeseen happens, you need to have that covered first.
Yeah.
And then from there, maybe make some slightly more aggressive type investments. What do you normally, generally speaking, like I said, there's a lot of variety there, right? You could, everyone's in a different situation. You're starting out an entry-level job, you could be a CEO of a company. Generally speaking, what percentage of people's, liquid assets would you normally recommend they have on hand, cash in a bank or something like that, not earning any interest, obviously, versus, something invested in the financial products, financial markets that they may not need to touch for a long time?
Yeah. So, I mean, unfortunately, these days, interest is like
nothing.
Negative.
So, is it going to go negative ever? I keep hearing that. Is there such a thing as negative interest? What do you owe them how does that even work?
Pretty much. It's pretty bad. Yeah. It's pretty bad when you're earning nothing. Like you pretty much you're basically are paying the bank in some aspects. Like right now,
paying the bank to keep holding your money.
Putting your money there, they're charging you a service fee.
They probably would start charging more fees, right? Just to compensate for the negative interest at that point. There would be no more free accounts, probably, right?
Probably. I mean, banks have to figure a way to do something.
Sure.
In terms of that, I mean, the first thing I always want to tell people, and this goes for any client. I mean, well, first of all, every client's going to be different. So, or any person and, family or anybody's going to be different. I think you can't do what everybody else is doing when it comes to any of it. Investing or savings, do what fits do what fits for you and not for what other people are doing. Don't always, the water cooler talk of I bought this and I bought that, or I bought Tesla at $250 and look where it is now. Those kind of conversations, they might work for one person, but they might not work for you. So, pick your plan, run with it and go with it. In terms of what I tell people to save in terms of liquid assets, first thing I always look at is like, what do you have in cash now? Like that's liquid, like that you can turn around tomorrow and actually take out in cash with minimal tax hits if anything is. So building an emergency fund is your first thing is really important, is having expenses put aside for like 6 to 9 months. Okay. That's usually, it depends on the people. Sometimes, 3 at a minimum, but on average around 6 to 9 months of savings for emergency. That can range anything, like that's your fixed expenses. What turns how to pay your rent or your mortgage, turn your lights on, all the things you need to do on a monthly basis that you have to cover. Think about it. If you lost your job, it could take you 6 to 9 months, maybe 6 months to find a new one. You have to have those expenses put aside. Things like that. Just the first thing you want to put aside, that the rainy day fund.
So before anyone should even think about, buying financial products and any of that type of stuff, get the 6 to 9 months first. Anything beyond that,
Well,
or at least
not
a few
necessarily all
months
of it.
worth. You don't want to take your emergency savings and invest it. And by the way, you touched on something interesting we talk about a lot, because you mentioned Tesla and like the shiny objects people want to show off. You always say that, most people should not be buying individual stocks like that. It's not cut out for most people. A lot of people probably think, like you said, they hear a big name and everyone's at the water cooler. Oh, did you see what Tesla's doing? And they just kind of blindly go in. But anyone doing that should really be investing a lot of time, or speaking to a professional such as yourself or somebody before just throwing money at these names they hear.
I mean, there's nothing wrong with owning individual stocks. I mean, I own them. I mean,
yeah,
most people I know own individual stocks on their own, and they, have some accounts that they play around with. I think it's good to have, that gambling money on the side, and especially if you're buying names like more blue chip stocks that are like, the stocks that are never going anywhere.
Apple.
They're going to pay you. They're going to have nice to have them in your portfolio. But I don't believe that's my first thing is never make that your only saving, your only retirement accounts.
Right.
Don't put all your eggs in basket. Don't put all your money into Apple or into one name because you feel, they're never going to go anywhere.
Right.
It's great.
Never say never with anybody.
Right.
But overall, most of those blue chips will grow as the economy grows as well. A Microsoft or some,
Right. It's nothing. I believe in having them, but I think it's also best to diversify and have other stuff too, because, think of it this way: if you put all your money and you're like, I have 80% of my money in stocks and 20% in bonds. That 80% is all in like Apple or Microsoft and Tesla and Facebook. You're putting it all into these large cap names, but you're missing out on all the other sections of the equity market, the international market. So it makes sense in some ways to have those, to play around and have the growth, that let them grow and then use that, some of that money to buy, to diversify into other stuff. It's good to have a mixture of stuff. So I do believe that. I still think owning them is great, but I also like to have a mixture. I always recommend spreading it out across the board.
Mix in a few fun penny stocks too. Get your online gaming stocks and stuff like that.
Exactly.
I hear good things in that sector.
Right. So that's why, with those, you got to do what fits your budget and fits for you. I mean, but back to what you said about the emergency fund stuff, I would say, look, put your retirement money away, take money out of your paycheck for your 401k. Those things are, automatic. So I believe you should do. But I do believe before you start putting more money into the market and stuff and things like that, you really want to make sure you have enough for expenses. You don't want to have to get to a point where you have to sell things and then have taxes on them, if that's the case, to pay expenses.
If you buy a stock, it should be something that you plan to own for a long time. Unless you're a day trader or something like that, you're constant, but for a regular person, you should view it as a long-term investment.
Yeah, it depends.
For the most part.
For the most part. I mean, you have to take all the other things into consideration, when you're buying and selling a stock on a, short-term basis, what the insurance, what you're paying in taxes and at the end of the year. So things like that. But I think, making sure you're putting enough away first. You want to make, like I said, you want to make sure if you have expenses, you need to cover those first. And then you start putting more money in outside of your initial 401k or retirement money that you're taking out of your paycheck that you're getting a tax deduction on. You do that. And then so you kind of take a little bit from each.
Play fund.
Yeah, the play fund. The play fund should come after everything else.
Gotcha.
All your other stuff that your savings goals, all your other savings goals come first, then the play fund of what you want to buy, like these penny stocks that we talk about.
Be responsible, people.
Exactly.
Don't get obsessed with penny stocks. Speaking of investments, one of the most common ones you hear a ton about, and it confuses a lot of people, is life insurance. Yes. Like you said, if you have a family, that's something obviously to protect. People know traditional life insurance. You die, and your money, the policy goes to somebody. But there's a lot of different types of policies. You hear whole term whole life and term.
Yeah.
And a lot of people are using those for personal savings and retirement accounts and things like that too. Could you just a general overview, kind of explain the difference between whole life and all that, and if people should be using these for savings and in what cases that may be applicable and useful?
Yeah. So there's, again, life insurance is something that's important, I think, to provide income for somebody, for a family, either short-term or long-term for when, for if something was to happen to you. So the two types really are term and permanent life insurance, whole life insurance, which breaks whole life can then break down into different types, but we'll just call it permanent whole life insurance for this. Term, we'll compare it to like, owning a house versus renting.
Okay. Good
so
analogy.
Term is set for a certain amount of term of years. It could be 20 years, it could be 30 years, or it can be up until the age of 80. It can be, different types. And you have it for a set period of time. You have maybe, let's, for instance, example, $1 million policy. Mm-hmm. If you were to die during that term, your family, whoever you get, gets $1 million.
Beneficiary get paid. But if you outlive that term, no one's getting anything.
So say you die year 20,
right?
Day 1, policy's ended. You die that day, your family gets nothing.
No one gets a penny.
Right. So term is more is cheaper.
Premiums are much cheaper, right? Like a small percentage even of the whole.
Right. So term really pays out like maybe a small percentage of the time. Because think of it, if you're 40, if you're 30 years old and you buy a 20-year term, that covers you till you're 50.
Right.
Or if you buy it until you're 80, it gets more expensive over the years, so you don't want to hold it you're not going to hold it as long. It's really made to be cheap because the fact is it's used to just kind of cover you for the time
unforeseen deaths and things like that.
Right. And when you're still building your nest egg, it's made for younger people to have while you're getting older. You're not going to have a 70-year-old person going and buying a 20-year term policy because the price would be outrageous.
That makes perfect sense.
Yeah. So permanent life insurance, we'll look at it as ownership. You own it for the life.
Yes.
That's why it's more expensive. You own it for your entire life. And basically it's looking at you're going to pay in over a certain amount of time. There's ways to structure it. There are some people that look at it think it's, that's a whole other topic of thinking it's a waste of money and not do it. It's not meant for everybody. I'll be straightforward with this. It's not meant for everybody. It's meant for, some people it works perfectly and some people it's just not meant for. So you think about it as it's owning. So like think about owning the house. Mm-hmm. You have your mortgage, make your mortgage payment. That's the same thing as paying your premium for the policy.
Right.
You build equity inside your house. In permanent life insurance, the death benefit increases over time and is also has a cash component that increases over time, which is like the equity in your house. You can take money out of it when needed. You can put the money back as well.
It works to own. You're owning this policy.
Exactly. You own it for life. So you could be 120 years old and it's going to pay you out if you passed away at 120.
Right.
I think at 121, they basically just give you back the whole entire amount because you've outlived the entire policy. So, so at 99 years old, your beneficiaries are going to receive something.
If you reach a certain age too, you can then now take that money. Let's say you've paid your premium all those years, you've never taken a penny out.
Yep.
And at a certain point, I don't know what the length of time, I guess it's different depending on the policy, right? But at some point you can then say, I'm going to take this $1 million as my $1 million. But
not necessarily. You could take out, you can't just say I'm getting it all. It has the death benefit. What it does is the equity inside, which like we said is like house equity, the cash value of it inside builds up over time. The insurance company pays a dividend to you on a annual basis.
And you can reinvest that dividend, right?
Usually you would reinvest it, yeah. It's the goal is to reinvest it so it buys more insurance inside the policy, and then it keeps growing over time, and then each year. So there are some parts of it that, there are nuances where like, it's a long-term it's not investment, it's a long-term play. Like, the first few years are your paying years, you're putting the money into it, that's the cost. But then usually by like, the 6th year, you're basically earning more than you're putting in. And it never goes down.
Right.
So that's the plus. It can never go down. It's not tied to the regular permanent life insurance is not tied to the market.
It's a safe
that's
play.
The good thing about it. That's the plus with that. There's no market correlation in terms of, what your fund does. There are products that do that, but that's a whole other conversation. We're talking just basic terms. But yeah, when you get older, so back to your other questions, like what do people use it for? So when you get older,
you hear people using it for savings. Sorry.
You can use it as a savings, right? You can use the cash value that builds up to it as as that money. You can use that later in life and say you want to put money towards a business, or at a time like this, we'll say like here, market drop 30%. People have taken money out of the cash value,
right?
Invested in the market.
Smart.
And then later on put it back in if they'd like, or just take it out if they wanted. So whatever you put in, you can take out, and then you can take that back out. It's not like you're lost it.
With no penalty.
No penalty, right.
And what's the downside to using that, is to thinking of it as a savings? Because a lot of people kind of go in and they buy those not thinking of it like I need life insurance for beneficiaries. They go in thinking I'm actually purchasing this as, like you said, to have equity and have a savings account that's going to earn more than sticking my money in a bank. Are there better options than that?
Well, I mean, you're going to earn, I mean, at this point right now, like, if you're comparing the rates of return, your rates of return are higher than what you're earning in the market right now, obviously, and you're not getting, it's tax deferred growth over time. So there's no, on an annual basis, you're not getting taxed on the earnings that are, it's getting reinvested. You're earning in the, basically right now, like you said, interest, you're earning less than maybe 1% in a money market, in a high yield money market, but then you're getting taxed on that. Right. Treasuries are earning very little right now, and then federal, you get taxed on those. Munis aren't earning as much either. So if you can earn 4 or 5% in a permanent life insurance policy, if that's what at the time that it's paying, that's tax deferred growth. You're not really finding a better investment that's not correlated to the market. That's going to be it's not really an investment, but a better return. What we see a lot of people using it for also is because you're putting the money away and you want to use some of your retirement. Yes. So you're putting the money away, and then when you retire, you can take the money out up to your basis tax-free. So you're putting this away, and you're saying, I'm going to take about $10 or $50, maybe $5,000 or $10,000 out, or whatever, maybe even more a year, to lower what you need to have in retirement. So it allows you to take some extra money. So you're lowering your, maybe you want $100,000 to retire on. You take 10, 15,000 out of that. You only have to come up with another 85 that you might get taxed on instead of, this is tax-free money. It works similar to a Roth in some aspects. And
you can put a lot more in.
It's been called the rich man's Roth. Right. There's the articles you'll see out there online called the rich man's Roth, and that's a good way to look at it.
Because the Roth, you're limited to what, $6,000 a year?
With a Roth, you're limited to a Roth of $6,000 a year. With this, you can put in as much as you want.
Policy and put in whatever you want, right?
Right. I mean, you can set the policy, and you can open a policy. You can put a policy in place for whatever amount of money you want when you open it.
Right.
It's flexible in some aspects, but the thing is, it's not meant for everybody.
And they're huge premiums. I mean, if you're talking millions on a permanent life policy, you're talking huge premiums for people, especially if you're 30s, 40s, 50s, or anything like that.
Right.
You'd have to be a very young.
Right, the fairly, so that's a good point. So the fairly young you are,
like you said, start early. You get in on one of those when you're like 19 or 20. You're gonna be money.
Right. And that goes for all like insurance, like life and disability and stuff. The younger you are, think about it. Like life insurance and disability is based off your health. Mm-hmm. It's actuary tables of how long you can live, but it's also based on your health. When are you the healthiest?
Right.
I mean, are you healthier at 40?
And when are you
or healthier at 25 or 30?
Right. And your premium will reflect that for sure.
Right. There's ways like term life insurance can be converted to permanent life insurance. That's why it's great to start with that when you start younger.
Especially if you're young.
Have that building block to turn it into something better down the road at a younger age, and you lock in your health at a younger age. You get the cheap
premium, and you can convert that to equity later on.
Right. There's ways to use it for your advantage for there's ways to use it for, like I said, retirement. There's people use it for things that they want to be able to purchase down the road. It has advantages. It's a great way to build an estate and legacy. I hear a lot, I want to leave a legacy. I want my kids to be taken care of. All right, well, you want your kids to be, there's plenty of ways to do, you have your assets, but if you want something that's going to be given to them tax-free, and that's not part of your, a life insurance is a way to do it. Term insurance will bridge a gap for a time being, but it'll also help you put something in place, but allow you to convert it as your income grows and things like that. It'll help you, be able to do that down the road. We've seen people use it. I've seen clients use it for even, and it sounds morbid, but juvenile policies, not like for the death reason, but as growing for the savings reasons. I mean, you have a child. look at the health of a 1-year-old.
That's actually clever. You can take out life insurance on your healthy child.
$70 a month into that instead of what would they? We used to get savings bonds.
Yes, there's a reason to have a kid. You can get some really cheap life insurance on your healthy baby.
But it's more for the point of just having them for.
And you can get a matern policy right when they're 1, and then when they're 21. No, seriously, you do right. You could do a term.
You wouldn't do it a term policy. I mean, it would be more of a
the term. Policy. Sorry, that would defeat the purpose. right. But you could get a permanent policy on your 1-year-old healthy baby, probably pretty cheap.
Very cheap. But it's more of like the savings aspect. Like you have it helps pay for college education for them. Yes. It also gives them something that to use money for a wedding.
Yes.
It has that cash.
And then when they get older, they can take over the payments on it and become their policy the rest of their life. Yeah, you're starting.
Grandpa want to put $50 into their account every birthday. There's money you can use as as part of their education or just for their savings goals.
That's perfect. I like that tip.
There's ways to use it. I mean, it's like you said, we know certain people that don't like it, and
right.
I think it's not meant for everybody. I think it's meant for certain people.
Yes. People, like you said at the beginning, people should always do what they're personally comfortable with.
Right.
Everybody's going to be different. Everybody's going to, be tailor-made to different products.
Yeah.
Be comfortable with different things. Like you said, it's not subject to what the market is doing. So that's especially now, as we talked about in the beginning, if people are going, hey, what's somewhere I can put my money where I know it's going to earn a little bit and not be subject to whatever roller coasters going on in the market. That's a perfect.
Right. It's funny you say roller. I feel like I've said that probably to you in the past. It's like, a lot of our clients, I was fully experiencing this, a lot of our clients and a lot of my, people I speak to is as you get older, you have a stronger desire for safe money and safe dollars. Look, a 20-year-old or a 25-year-old's not looking to put money away that's going to earn nothing. They want the exciting roller coaster investments.
Right.
The 3 segments of the investments. You have your home runs, your real estate, and your businesses. You have your next sector, which is your aggressive one, like your roller coaster sector, your 401ks, your investments. But then as you get older, you have more of a need for the safe dollars and a better understanding and a desire for it. And that's what permanent life insurance really is. It's the safe dollars.
No one's trying to strike it rich at 80 years old. They just want to be comfortable at that point.
It's right. You're going to have this later in life to fall back on. And a big advantage of it is like retirement times. Like, look at now, not to go into a different whole topic of like,
no, please.
The market is, you take a time like now when the market drops. What if you were to retire? What if you were due to retire on December 31st?
Right.
2019.
Right.
Or take it back. Take it back to 2007.
Was it March 2020? When was it like really at the bottom?
Oh, March. Yeah, March 2020 is when it really
year.
But think about it. Even take it back to 2000, like right before the big blow up of the mortgage rate blow up in in 08. So what if you retired then?
Right.
And all of a sudden you just lost like 50% of your assets. Like even that. How long is it going to take you to get that 50% back?
Right.
So it's more of like, the one thing you don't want to be taking, the one thing I always say, you don't want to take money out of accounts when the market is down.
Right.
Never. And there's ways to show it.
The only way you actually, we talked about it, the only way you actually ever lose money is once you take it out. Until you take it out, you haven't actually lost anything.
Exactly. You haven't lost anything until you actually take it out.
Right.
Right.
If you own a stock or anything and whatever you own,
right,
just a number on a screen, you still own, that product, you still own that amount of shares or that mutual fund with those amount of shares in it.
Right.
That's not changing. The value fluctuates. You're locking in that loss if you take it out. So unless you really, really need it and it's an emergency, don't touch it if it's down.
Right. Right. And that's why when you plan it out, you plan to be able to have other buckets of money or income sources outside of your retirement planning or as part of your retirement planning, but other buckets outside of your 401k and your IRA that you can dip into when the time like this is necessary. So you want to have those safe dollars. That's why sometimes permanent works in that aspect. Permanent life insurance will help investors do that. But again, like I said, it's not for everybody. because of the commitment you make towards it in terms of how much you put into it. But it's something that could, if you start younger, it's actually something that builds up, and the compounding of it, which is the key word of compounding, like compounding interest is the key word. And the longer you do it for, the more beneficial it is. So, those are the things we kind of trying to make people understand. And we build it into their plan. If it's something, we build it into retirement planning, if it's something that fits.
So Jay will, because I'm going to wind it down here, and that's a perfect point he was just making. They will build, and you'll tell them again where to email you and stuff like that. But it's so useful. I mean, if you're talking about even a small amount of money, whatever it is that you have, that you think, I want some security for the family, or I want some security for my own future, whatever it is, you really should speak to someone like Jay that understands all this kind of stuff, and, that you can trust and talk to and ask, questions of. There's nothing more valuable. You don't ever just want to go blindly into something and throw your money at something and hope for the best. So educate yourselves. And before I let you go, Jay, what's going on with Springsteen, man? Are they? How many shows have you been to?
I don't know.
Not
as many as other people that I hear.
How many Boss songs are on your Apple iTunes?
If I actually looked at it, I mean, I have every album on there probably. So
every album ever, plus all the live stuff.
Plus the live stuff that I, sporadically buy and download from the sites. I think one year I probably went to, and I think the last time he played at MetLife Giant Stadium, I think I probably went to 3 shows in a matter of a week.
Sound like Des with the Korean boys.
Not even close.
Didn't you guys saw the Broadway show recently too, right? Bruce on Broadway or whatever?
Yes, we did see him we saw him on Broadway. I think we see him once on Broadway, maybe twice. I think.
Yeah.
Can't remember how many times.
You've seen a lot when you can't remember how many.
I still listen to that show, but yeah, we saw him. It was great. I think that's the one station that's always on my in my car.
Nice.
The
Sirius,
station.
Right? Sirius
Yep.
Springsteen channel. He has his own channel. There you go. You made it when you get your own channel on Sirius.
Exactly.
You have a deep library if they can even make your own channel.
They can get it for more than a week.
Yeah, without playing the same 4 songs over and over. Jay, thank you. Honestly, this was great.
My pleasure, John.
You've given a lot of people some really good information. And please tell me, because I'm horrible with remembering things, tell me the email one more time so people can reach you if they need anything. And guys, if you need to get a hold of Jay or anything, you can always reach out to me as well. Anybody that knows me or anything like that, just hit me up online. Go ahead. Sorry.
It's my email at work, jay.appel@nm.com. And then otherwise reach out to John and, he'll get me in touch.
NM, that's Northwestern Mutual. Jay is a financial advisor. He was also a hedge fund manager and all kinds of stuff. He's been in the field a long time. He knows what he's talking about. Thank you again. I really appreciate it. Hope everybody's having a great day and a great week. And we'll be back in a couple of days. We're going to try to get Jay on here as a regular guest. We'll do some more fun stuff so we're not boring everybody with numbers and finances and all that. We'll talk some sports. We'll debate some Giants, Redskins. Am I allowed to say Redskins anymore? Damn it.
There you go.
The Washington football team.
The Washington football team.
Wasn't even going to bring this up. It's horrible. Is a Native American offended by the term Redskin? Has anybody ever, first of all, this is totally, has anybody ever in the history of the U.S. used the term Redskin as a derogatory term to somebody's face? Like, was that ever a thing in this country? That guy's a Redskin. And then they named their team that as an homage to these proud warriors. You're not going to name your team something derogatory that you think shittily of. You're going to name them something that you think is a proud image. And when they used to do these polls, 90-something% of Native Americans said they didn't give a shit. And like 60% of white snowflakes said they did care. Stop being upset on other people's behalfs. Nobody cared about the name. Stop trying to wedge it into this other.
And they're not even good, so I don't know why people care.
They're not even good. We haven't been good in 30 years.
Exactly.
Now they're not even the Redskins anymore. I'm keeping everything I have that says Redskins on it.
They've been good since what? John Riggins?
Killing me.
Doug Williams?
Mark Rippon?
Yeah.
Rippon was the last Super Bowl, I guess the last playoffs. I mean, we had a couple. Gus Frerotte had a couple little runs, and then Trent Dilfer and that. No, not Dilfer. What was that? I don't know. We have Brad Johnson maybe made the playoffs. Some bad teams. It's been
Very
a long
bad.
time. All right, I'm going to let you go. We'll be back in a couple days. You guys will see Jay in probably a week or so. And like I said, hope everyone's having a great week. Thank you all so much for tuning in, for subscribing, downloading, watching everything. I appreciate you all so much. And we'll see you soon. Thank you. Peace.
Take care.